seconds, 10 seconds, we're going to officially start the meeting if you're ready. Okay. Good morning, everybody. Welcome to the Trustee of Trust Funds of the Town of Merrimack meeting for May 21st. As usual, I'd like to just start around the room, and I don't know how this works on your screens, but if you want to just introduce yourself and why you're here, and we'll press on. So I'm going to start with Tom Boland up in the upper left.
Tom Boland, Deputy Finance Director and Treasurer for the Town of Merrimack.
Oh, and I guess I should introduce myself. I'm Chris Christensen, Chairman. And next I have Judy Knoll.
Judith Noel from Cambridge Trust Company.
Jack Balcom, Town Trustee.
Lindsay
Donovan, Cambridge Trust Company.
Eric
Jusom, Cambridge Trust Company.
Ed Hilston, guest.
Bill Wilkes, Trustee, Merrimack.
And I guess that's it, right?
Yes.
Okay. So the first order of business is the approval of the minutes of February 21st. For those, I think that's a long time ago, it was, but we did not have a meeting in March or April. So we're sort of reverting back to the days when we only met quarterly. In any event, do we have a motion relative to the minutes of February 21?
I move we accept the minutes for February 21.
Second.
All right, moved by Jack, second by Bill. All in favor?
Aye.
Aye. 3-0-0. And the next item on the agenda is correspondence. To my knowledge, we don't have anything significant. We had some scholarships that have been worked off and paid. But Tom, are you aware of anything in the mail slot?
No, I checked this morning before the meeting. There's just some proxy materials from Duke Energy. That's all that was in there.
Okay, thank you. Which brings us to our portfolio review from Cambridge Trust Company. So Judith, you've got the floor.
Well, I'm going to hand the floor over to Eric and Lindsay, who will speak to our presentation.
Okay. I will start with a market overview, and then I'll pass it on to Lindsay to go over the portfolio's returns and characteristics. Is there a screen that we should be looking at, or do you want me to pull it up on my side?
If you can pull it up on your side, that's fine.
Okay, I will do that. Yeah, I'm not able to find, Lindsay, you know how to pull up the screen by chance, the presentation?
Let me try.
Okay.
You might as well just skip to the U.S. valuations page.
I think I got it right here.
Yep, that's the one I have.
Okay. Okay, so I'm going to start looking at U.S. valuations. So as you can see, the market's obviously been very, there's been a lot of turmoil and a lot of volatility in the markets. You can see as of March 31st, if we look at the forward multiple of the S&P 500, it was trading a little over 15 times, down from the year-end number, which was close to about 19 and a half times earnings. So for all intents and purposes, we had a bear market correction in March, where the S&P at its lowest point was down about 30%. And through yesterday, the markets have rallied. So year to date through yesterday, the S&P is only down 7.5%. But it's interesting to note, so the broad market as a whole, which has really been led by tech, which has really led the charge in the post March 23rd, which is the bottom of the market rally. But if you look at dividend-paying stocks, have severely lagged the return of the broad S&P 500. So if you look at like a dividend proxy of DY, the ETF, that's down almost 25% for the year. So the portfolios that we're managing for you that have the equity exposure have more of that dividend tilt towards them. And they're not down as much, but they're underperforming the S&P just because it's been more of that. The tech, the FANG stocks have really led the charge on this recovery here. Obviously, the government has been very active in putting stimulus to work. So the first round of the CARES Act was a little over about $2.5 trillion, or representing about 11% of GDP. So really, the governments have come in not just with fiscal policy, but also monetary policy. So the Fed in early March lowered the Fed funds rate to a range of 0 to 25 basis points, and since then has now announced about 30 additional programs to help ease the strain in the financial market. In the middle of March, the credit markets, especially investment grade, companies were not able to access the markets. There was pretty much a line drawn that companies could not issue debt. The Fed came in, announced the primary credit facility as well as the secondary market credit facility. Even though they didn't exactly put the money to work, it was just the announcement of that really allowed capital to flow back into the market. So as a point of reference, the portfolios have exposure to corporate bonds. On March 23rd, which is when the S&P 500, as well as if you look at just the investment grade credit index, that had widened to over 400 basis points, and since tightened about 200 basis points. So we've seen a nice rally, not just in equities, but in investment grade corporate as well. High yields lagging as there's more concern about defaults. But overall, the markets, considering the volatility we've had, are only down about 7.5% as measured by the S&P 500 for yesterday. As I mentioned a minute ago, the Fed and interest rates. I'm on page 5 or page 4 at the bottom. As I mentioned earlier, the Fed has basically anchored interest rates at 0. There's really no catalyst unless we see growth come back into the market to really get rates to move higher. So we're in this lower for longer camp. Back at the beginning of January, the 10-year Treasury was 1.8%, and this morning it's 66 basis points. So we've had a tremendous rally in interest rates. Obviously, we're all aware of the pandemic, the global implications, not just and also the U.S. economic turmoil. And just this morning, an additional almost 3 million Americans filed for unemployment benefits. So the unemployment rate has continued to move higher. It's probably going to be in the low 20 handle. GDP for the second quarter is expected to have, probably a negative teens type number to it. And, slowly, the economies in each states are starting to come back online, but it's going to take a long time until there's an actual vaccine in place to get growth to, similar to what we had pre-pandemic. At that point, U.S. economy was growing about 2 to 2.5%. So so just turning to the next page, looking at fixed income returns. So obviously, with the drop in interest rates, bond returns have been really strong, especially if you had Treasury or agency exposure. Through the month, through the end of March, we've had a bigger rally in corporate. Corporate bonds are basically flat for the year, raising at 3.6% decline through Q1. As I was mentioning a little earlier, the global economic activity. So this chart here on page 6 looks at global manufacturing, and it's basically stalled. If you look over on the far right under the year 2020, so you can see February to March, just how this pandemic has affected global economic activity. So look at the developed economies. UK's PMI was 52, it dropped to 35. Japan went from 46 to 32. The Euro area was from the low 50s to the mid 20s. Germany went from 52 to 34. US went from 49 to 39 and continuing to decline. So the global economies were slowing coming into 2020. A lot of economists were talking, a recession maybe at year end or at some point in 2021 right now that we're in that recession right now. And until there's an actual vaccine that's widely available, it's going to take a while to get these economies to come full on, as there's concern that the second wave could happen in the fall.
You're up for the question. That again with the source of these figures?
The source is just the manufacturing, so it's each country's purchasing manager's index.
And so each country supplies its own numbers?
Correct, yes.
Okay, best guess on some of them.
Well, especially, when you get towards China. But again, for all intents and purposes, the Chinese economy stopped in January and it's slowly starting to come back online. But it's going to take several quarters, especially when we move, with the U.S. coming back online to get, manufacturing and growth to come back up.
Thank you.
And with that, I will turn it over to Lindsay.
Great, thanks. I'm gonna share my own screen so that I
Okay.
can drive if that's okay.
All right, I'll stop
Yeah.
sharing.
Right. So starting on page 9 of the PDF document, can you all see my screen at this point?
Ooh,
Yes.
That's
Okay, great.
page 8, isn't it?
It is page 8 by the bottom page numbering system. Yes. So for the Merrimack Scholarship account, as of 5/12, the portfolio had 20.9% in cash, 21.6% in fixed income, 56.5% in equities, and a 1% position in alternatives, which is gold. We added gold during the first quarter to portfolios as an additional alternative source of investment. The total market value for this account is $236,296. It does follow our equity income strategy, which, as Eric mentioned previously, has more of a dividend tilt. Moving on to the next page, this is looking at the...
Hang on this page for a second, Lindsay.
Yep.
I had a couple of questions.
Sure.
We don't have any obligations to pay any scholarships until probably next December or January.
Okay.
And yet we've got 20% in cash. Is that just cash, or is it money markets, or are we making anything there?
So that is money market cash, and we did raise cash as a part of our strategies across the first quarter as the market was going down to increase the dry powder that was available, so that as new opportunities came up, we would be ready and available to have new investment. So currently it is about 9% underweight to fixed income and about 14% underweight to the midpoint of equities. So if you don't have any obligations for the scholarships until, did you say December of this year was the earliest?
Once in a while somebody calls in December, but usually they come in January, February.
January, February.
Yeah, so Chris, as Lindsay mentioned, we, as part of our overall, strategy as we're going through, February into March, we had raised cash, and now we're looking to deploy some of that cash. So knowing that, these funds aren't needed in the near term, we'll probably, move towards that target, which is closer to 70% in equities.
So just a question on the cash in general, like, I know that, I guess, Marcus, which is part of Goldman Sachs, I personally invested some money that I had sitting on the sidelines and got a pretty good relative to the world return on it. Do you guys do anything like that, or is that against your bank policy to invest in another institution like that?
Yeah, so we would typically not invest in another institution. All of our, portfolios are individual managed, with a predominance of individual stocks and individual bonds. So as Lindsay mentioned earlier, we actually added to the gold iShares as another hedge to the portfolio to have uncorrelated assets. right now, if you look at, the trades that we have made in the quarter have been really, a little more defensiveness, adding to Procter and Gamble, adding to Clorox. So I think as we move forward, we're looking at possibly, adding Walmart. We added to Broadcom. So we've been adding stocks, but it's been more of a one-off. Selling companies that we have less conviction in, and increasing positions that comes with more conviction in, or adding newer names that we think are going to be a better position for what could be this new global economy.
So I guess I just have a hard time understanding how $2,300 worth of gold is really a hedge, or, I mean, based on historical values for gold. I mean, is that really something that makes any sense, or what do you get out of a 1% position?
Well, again, that was our initial position was 1%. We may grow it over time, but I think, it was our foray to try to add a little bit of undiversified assets into the portfolio. And obviously 1% doesn't move the needle, but we think over time that, we may add some different asset classes that we're doing some research on. But, gold right now is 1%. It may increase over time.
Yeah, I want to echo what Bill is, I think what he's thinking, that, the job of this portfolio is to raise money so we can give it away. And if it doesn't pay a dividend, like gold doesn't pay a dividend, if you sell it and you get a capital gain, it doesn't do us any good. We can't give it away. We need dividends in order to give it away. We can't give away capital gains.
Yeah, I would be against increasing the gold position. I don't really personally think that has a benefit for this portfolio.
Yeah, I agree. I don't know what you think, Jack.
Well, it provides some kind of stability. I hold a lot of gold myself, and I haven't been hurt as badly in this economy. I don't know. It's a 1%. It's an open position, placeholder, if you will.
Well, that's all it is a bookend, because it doesn't seem to move significantly. I mean, it hasn't appreciated over the last several years significantly.
Yeah, the only way it can be of benefit to us is if we had a large capital gain and we sold it and then bought something that gave out a big dividend. Right now our yield is, what was it, 2.13%? 6 months ago we were looking at 2.89%, and we were hoping to improve on that. So I'm just questioning.
I mean, if we have blue chip stocks that have had a long history of paying dividends, I don't think and they continue to pay and increase their dividends. I don't think we really are sensitive to volatility in the value of the assets due to market fluctuations. I think as long as we're comfortable that the dividends are going to continue to exist and grow over time, that would be more important to us. So, like having a big cash position or having a position in gold, I think is contra to what we really want out of this portfolio.
Okay.
Yeah, and I mean, all the stocks in the portfolio, with the exception of gold, are there for the dividend paying aspect. So it's a 1% position, in the portfolio. We can sell it, and we can reposition it into, we can add some more Procter and Gamble or some other names to the portfolio and reposition it to get more dividend yield.
Yeah, I think that's the direction we really want to go.
Okay, we will take care of that.
Excuse me, Ed Hilston here. Your index on the bottom of the chart, is that a weighted index that you're using a comparison to?
The index, yes, it is looking at the taxable growth benchmark, which it's listed on the next page what the performance of that is. So it is a blend.
It's a blended index.
Yep.
All right, thank you.
Since it's a blended portfolio.
Thank you.
Question, Ed, thank you. Okay, Lindsay, moving on. Sorry to
Okay.
get you off schedule.
No problem. So the performance details for this portfolio, on a total return basis, year to date, through the end of April, the portfolio was down 8.9% versus the taxable growth benchmark, which was down 5.8%. Dividend stocks did lag versus the rest of the equity index during this time. So if we look down to the equity sleeve right there, for the year-to-date period, the equity portion of the portfolio was down 12.4% versus the S&P, which was down 9.29%. So being underweight to equities at this time has actually helped alleviate a little bit the total return of the portfolio. If it had been up to its full weighting of 70%, the portfolio would have been more exposed to that negative impact right there. So that was part of the thought process for raising cash during the February to March period. Yep.
I think in all due respect, if you did that analysis based on the close yesterday, the gap would be a lot more narrow because a lot of the lagging stocks have started to go back up. So,
Yes.
you know, it's really a short-term gyration when you think of 2 to 3 months to, you know, go through that gyration. And now we're back, you know, we're coming back to more equilibrium, so to speak.
Yep, absolutely. During the month of May, dividend stocks have certainly come back stronger than they did during the month of April. But there was a lag for dividend stocks during that month, especially compared to tech names.
But I'm not trying to pick on you personally, but I'm just saying generally that we don't care that there was a lag three months. Now they're coming back, and you know why the gyrations? I mean, we're long-term investors, so to speak, especially for this portfolio. You know, trading in and out over a 3-month period doesn't really make much sense to me personally.
Understood.
I think it goes back to the question of who cares what the value of the stock is as long as you're getting a 3% or a 4% yield.
Exactly.
As long as it's a steady dividend, and we're not planning to sell the stock for some unusual reason, like we expect them to cut the dividend, then, you know, a quarter here and a quarter there isn't a big deal.
Which that absolutely is the strategy that this portfolio is invested in. It's the equity sleeve is focused on those stocks that have dividends, which have had long stable dividends and are continuing to grow the dividend. But at the same time, we are trying to be nimble and be thoughtful when the market does have such a pullback as it did earlier this year, and try to protect from the downside as well. But I understand what you're saying, absolutely, that the purpose of this portfolio is to generate income for the scholarships for the town.
Okay, let's move on.
Okay.
Well, I have one question. It looks like you're doing it within the equities, some repositioning. You know, as what you said, you mentioned, let's see, you were moving into Walmart.
Yes.
Okay.
Yep, we have been doing some trades to reposition and to find dividend paying stocks that are undervalued, that our analysts like here, that have potential for growth, and that also do provide the dividend income that you're looking for here.
Yeah. Yeah, it'd be nice to come out of this burp with a nice portfolio.
Yep. So looking at the equity sector performance, which is on page 10, the way to look at this particular page, if you look down at the bottom sections, the blue bars are those of your account. versus the beige, which are those of the index. On the left-hand side are the sector allocations. So anywhere where the blue bar is shorter than the beige bar, we are underweight versus the index. Anywhere where the blue bar is longer, we're overweight versus the index. So for an example, you can see the first position is communication services. So we're underweight versus the index. If you go along to the other chart on the right-hand side of the bottom, you can also see that communication services was a sector where we underperformed relative to the index. So being underweight relative to that sector helps. Going down a few, if you look at healthcare, where we do carry an overweight versus the sector, we also did have, we actually had a little bit of underperformance there as well. But if you go to the next one down, which is the one that I was looking at, industrials, we have a slight overweight versus the index there, and we did have a less negative performance in that sector. So overall, combining the overweights and underweights as well as the relative returns, you can see up at the top, it does list out the various individual sector performances versus the year-to-date sector performances. So overall, it was a difficult quarter with so much of the market being down, but we did have outperformance on a relative basis within a number of sectors. And we had also reduced our overall energy exposure within the portfolio, which was pretty significantly down within the quarter, down 35%. So not having that exposure to energy also helped the relative performance of the portfolio within this sector, within this period.
I like the consumer staples.
Consumer staples are good, yes. Yeah. As you mentioned, this has been such a volatile market that as we moved from April into May, we continued to see more diverse returns within the different sectors as well. So this is the performance as of the end of April here. If we're ready to move on, we can talk about the Merrimack Water account. Merrimack Water currently has a total market value of a little bit more than $6 million. The estimated portfolio yield is 1.67% here. It is a capital reserve account, so it is much more conservatively positioned versus the scholarship or the principal and income accounts. Currently, there is about 1.7 million in cash, and there is another $500,000 that's maturing by month end. So I'd love to hear a little bit more about what the needs for cash might be over the next 6 months and what sort of reinvestment we might be able to do, where we did have 200 mature off the portfolio last week and another 500,000 by month end. So there's going to be a little bit more cash being built up within the month of May here.
Yeah, one of the problems we run into here is that the annual meeting for the MVD was scheduled for March, and it was postponed.
Okay.
It has not been held yet. It's next week.
Okay.
Presumably, could be postponed again. So they haven't passed a budget. Some of the things that are in that spreadsheet that we had last time we met are pretty much still accurate.
Okay. So would you like us to reinvest based on what was shown in that spreadsheet, or would you like us to touch base with you next week after the water department has had its annual meeting?
Can you give us a little update on, like, if you were to reinvest into like 3, 6, 9 months, a year, where you're reinvesting and what kind of return you're getting?
So rates have come down very significantly. over the past couple of months since the Fed dropped rates. So if you give me just 1 second, I can pull up what they actually are at this moment. So for treasuries, the 3-month is currently 11 basis points. The 6-month is 13 basis points, and the 1-year is 15 basis points. So everything has come down very significantly compared to what we had been seeing the last time that we had met. And similarly, CD rates have come down during that time period as well. I'm just pulling up that document as well so I can give you what they are as of today. So the 3-month is about 15 basis points. The 6-month is between 15 to 20. And the 1-year is between 20 to 25, depending on the credit. So the overall rates have come down very significantly since the Federal Reserve did cut rates earlier this year.
I'm just concerned that, given the situation, if it makes sense to stay pretty short term with the thought process of, once we do get a recovery, the rates will trend back up again, versus, I think for treasuries, you said there was like a 2 or 3 basis point delta. That's
between a
almost
3-month
that's almost
and
infinitesimal. So is it better to stay like in a 3-month position, and with the anticipation of getting a recovery and higher rates towards the latter summer and fall timeframe? What's the philosophy? What's the thought process at Cambridge Trust?
So,
Yeah, it's hard to say that rates are going to move dramatically higher, especially in the front part of the curve where the Fed's basically anchoring rates towards zero, that zero bound. And there's actually been less talk, but there was talk several weeks ago, and the market was starting to price in a higher likelihood of negative rates. So I agree. You don't want to reach for yield in this environment. The yield, the delta between a 1 and a 2 year is a basis point. So at that point, stay with the 1 year and not lock it out for 2 years. I think if you can find securities that are going to beat a money market but not reach for yield, you want to sort of lock it in and hedge that. Again, these are short-term portfolios. They're 1 to 3 year ladders, so you're always having cash flow that's rolling off of the portfolio. So we typically would not go out and a lot of these accounts to go and buy a 5 or 10 year bond. And some of the other accounts, it's more of a longer term horizon. We would do, we have done that, but here in these accounts, it's more of a 1 to 3 year ladder. With treasuries as well as CDs. So I agree. I think we wouldn't go more than 1 year. So you figure a year from now, you're looking at late May, June of 2021. Hopefully we have hopefully this pandemic has subsided. You're seeing growth come back on. And maybe at that point you see rates move higher. But I think in the next 6 months or so, long rates may move slightly higher depending upon some economic data that is less bad than what is expected. But short rates really until the Fed, the market starts to price in a higher likelihood of the Fed raising rates. Short rates aren't going to move that much higher.
Yeah, that makes sense to me. The goal here, under the law, is preservation of capital. If you make some money on the side, that's nice, but it's never going to be huge returns. Usually we try to make enough to cover expenses and maybe a little bit after that. So short term makes sense for the next couple of quarters.
Yeah, I'm even thinking less than a year, Eric.
I would point out that for the most, and again, we will know more in a week or two, but they don't know what they're going to do with it. The MVD has $2 million in their checkbook. They keep for contingencies. So when they need money, they don't necessarily need 300,000 or 500,000 tomorrow to pay the bills. So we've got some lead time there. So I think the existing ladder is appropriate.
Chris, Michelle did mention she was gonna send an updated spreadsheet later today.
Okay,
So we can see if there's any significant changes from what we were looking at before.
all right, good input, Tom, thank you. I hadn't seen that email yet.
So moving on to the next page, looking at the performance details. The total return of this portfolio on a year-to-date basis through the end of April was 1.47%. You can see that the cash returned 36 basis points, since money markets were yielding more at the beginning of the year, versus 35 basis points for the Lipper money market, which is the average. On the fixed income portion, it has returned 1.79%, versus the benchmark, which was up 3.8%. As you mentioned, Chris, this portfolio is heavily invested into those instruments that have capital preservation in mind. So certificates of deposit, as well as U.S. Treasuries, while the benchmark does have a little bit more credit risk. So there's a little bit of a mismatch there between the two. Also, we were overweight to CDs within the portfolio, which typically have had a little bit more of a spread versus Treasuries, and CDs have performed very strongly within the first few months of the year here. Looking to the next account, the Merrimack Muni account, total market value is currently $7.5 million. The estimated portfolio yield is 1.3%. Similar structure with capital preservation in mind for this portfolio as well. We did have 175,000 additionally mature last week, and there's another 75,000 maturing by month end. So principal within this portfolio at this time for cash is about $2.5 million. And I know that typically in the month of June, you have needed about $2 million for available in cash to be distributed. So just checking in to see if that's still the case, and what the plans are for this portfolio as well in terms of cash needs at this point.
I think that's accurate. Tom, do you have any update on that?
That is right about the $2 million mark is what we're projecting to have for needs, unless there's some big purchases in the next couple of weeks. But right now, that's where we're at.
Great.
Okay.
Well, 2.7. I mean, $700,000 is a lot to me.
So it is 2.7, but that is the combination of principal as well as income cash there. So in principal, it's just about $2.5 million.
Okay.
So we can, and there is another 75 maturing prior to month end. So we could reinvest another 200,000 to bring that down to 2.5 overall in cash, which would leave about 500,000 after the distribution in June. Just want to make sure that would be sufficient if, as you said, there are any last minute purchase requirements.
Well, I'm kind of thinking that anticipated tax revenues that normally come in this month or come in June, early July, may be delayed.
Right.
So from that point of view, if there's capital reserve expenditures early in the year to compensate for that, I think we need to be cautious about reinvesting at least for another 75 days.
Okay. Yeah, that's not a problem. And why I wanted to talk about the cash situation with you, I wasn't sure what the cash needs might be. So we can keep it in cash and discuss going forward as you get more information about the tax receipts, if that works.
Yeah, again, the budget hasn't been passed.
Mhm.
We're scheduled to vote on June 23rd, probably.
There is also the prospect of that fire truck purchase, Chris, that is now looking like it might be in the late fall, maybe November, December timeframe, for about $600,000.
Okay.
That we should keep in the back of our minds as well.
Okay. So write that on the back of your wrist, Lindsay.
I will. I just wrote it down. We do have a ladder of securities within the portfolio, so there is more maturities happening throughout the year. So I'll take a look and see what's coming up prior to that November date. You had said 600,000, right?
Yes.
Okay, thank you. Just wanted to double
Has that
check.
actually gone out to bid, Tom?
I don't believe it has yet.
Okay.
Great. So looking at performance here, similar to what we saw with the water account, total return for the year-to-date period, 1.36%. The cash return 40 basis points versus the money market up 35 basis points. And the fixed income CD portion returned 2% versus the benchmark, which was up 3.8% here. Moving on to the school account. Total market value here is $784,000. Estimated portfolio yield 1.08%. Cash did go up. We just had a $100,000 maturity that happened last week. So there is $403,000 available in cash. Similar structure here, a capital reserve account. So it is treasuries and CDs that comprise the portfolio. Would you be able to give us any information on cash needs for the schools at this time, or should we plan to invest down the $100,000 that just matured?
I'd go ahead and invest the 100,000.
Okay.
We don't know what the school budget officially will be until it passes on June 23rd. But they don't have a lot of money here. They don't have a lot of expenditures. They put everything in their operating budget.
Right.
If they have expenditures, a lot of times it's for special ed or stuff that comes up in September, and they usually have sufficient in their working budget or working operating budget to cover short term anyway. So I think we're okay to just go ahead with 100,000. What are we keeping? About 300 in cash?
It's usually somewhere between 250 and 300. Yes.
Yeah. Okay.
So I can reinvest that 100, and then similar to Muni, once that June 23rd meeting happens, if you let us know any more expenditures that might be coming up, we can invest more cash or leave it to the sideline depending on what your needs are.
Okay.
Great. Performance details here. Year to date, the total return of the portfolio is up 89 basis points. Cash was up 29 basis points versus the money market up. Wrong one. Cash was up 41 basis points versus the Lipper money market up 35 basis points. And the fixed income sleeve was up 1.4% versus the benchmark up 3.8. Moving on to the income account. This account does have a moderate growth objective. Total market value is just a little bit more than $3 million here. Estimated portfolio yield 2.3%. Cash is currently 7.9%. Fixed income 38.6%. Equity is 52.5%. And alternatives, which is a position in gold, is 0.9% here. Looking to performance on a year-to-date basis.
Excuse me, I'm gonna say the same thing here about gold that we had on the previous discussion.
Yes, we'll take the gold out of the portfolios and reallocate into dividend paying stocks.
Moving on. I'm sorry to interrupt. Excuse me.
Total return for this portfolio is negative 6.7% on the year-to-date basis versus the taxable moderate growth benchmark down 4.3% for the year-to-date as well. Moving on, page 19 is very similar to the one that I went over previously for the scholarship account as well. So I'm just going to skip past that. Looking to Merrimack Principal account. This account has a growth investment objective. Total market value is $4.35 million. Estimated portfolio yield is 2.31%. Cash is currently 5.7%. Fixed income 34.5%. Equities 58.8%, and alternatives 1%. So as Eric said, we will reposition that gold into dividend paying stocks as well. And the performance details, on a year-to-date basis, total return was down 9.4%, while the benchmark was down 5.8%. So again, similarly invested to the other two portfolios for the equity sleeve here as well. And similarly, this equity sector page is also very similar to those two. And that's the end of our performance book for this meeting.
Good job. Thank you.
Thank you.
Thank you.
I have a question about capital reserve funds.
Yes.
And in today's interest rates, medium, probably not significant, but years ago, we used to invest in other government guaranteed securities, small business administration loans, agriculture loans, bonds rather. And I was just wondering if there's still any kind of a market for that stuff, or is it pretty much dropped out of anybody's investment portfolios?
SBA loans are still available, but they typically have a little bit of a depends upon what maturity bracket you're looking at and what how expensive they are. We feel corporate bonds right now are offering a pretty good value, with the sell-off and the widening of their credit spreads. Even though the SBA loans are government guaranteed, anything that the government is supporting is very expensive in this environment. We bought mortgage-backed securities for the principal and income account. And even those right now, those are trading, you can't buy them at less than a $104 price handle, which puts the risk of, if interest rates rise, that you're going to have some negative returns built in. Yep. So I think at this point here, we're probably going to shy away from any type of government-backed loan just because they're too expensive. And, where the opportunity, especially for principal and income, and most of the cash that's there is earmarked for equities, but if there's a reinvestment opportunity, you see recent trades have been focusing more on the corporate bond sector. We're finding better relative value.
Yeah, I was thinking primarily for the capital reserve funds where we can only buy government guaranteed. So I was just curious where the market was on that stuff.
Yeah, again, you're paying over par. So for capital reserve account, it kind of defeats the purpose that you're already paying over the par and you're going to have that negative return on principal.
Just checking in.
Yeah, no worries.
Jack, Bill, anybody else have any other questions?
Nope.
I'm good.
Okay. Excellent job, people. Let's see what I can find for the next page of the agenda. Okay, so the next commentary is elections, and we've talked about that in terms of the rescheduling.
Where are the Zoom donuts? I'm just asking for Jack, not for myself.
Right.
Well, I get a free donut at Dunkin' tomorrow. It's Friday.
Okay.
I'll see if Zoom donuts are available for the next meeting.
Yeah, we'll watch you eat it, Judy. Um, don't think we have anything else urgent. Our next meeting, I think, is likely to be mid-late June, and we'll probably have the request for capital reserve funds prior to that. So if we want a generic motion to authorize that transaction, I would think that might be a good thing to do and have in our pockets. But I'm willing to discuss. Anybody?
Bill?
Go ahead, Jack.
Oh, okay. I so moved.
Second.
Okay, all in favor? Aye.
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 All right, that'll get us, so at least that transaction will clear before the end of the fiscal year. I don't know if anybody has a calendar handy. Let me pull mine out. If we meet on a Friday, our next meeting would be June 19th. We normally don't meet in July, but we could have a quick one if it turns out we need to do anything significant based on town meeting or MVD meeting results. And then we go normally to the end of August because we have to pass and promote a new investment policy as well as the annual state reports. Judy, you still there?
I am still here.
Are we likely to be good? Have you heard any more about state reports or the formats? Are they making changes to mess it up again?
As far as I know, there are no changes.
Yeah, okay.
We'll complete the reports based on how they were completed last year.
And we have some potential. So I'm gonna leave those meeting dates open. We'll say June 19th, if that's okay with everybody.
It's okay for me.
Okay with me.
All right. And then we have training potentially coming up. I think you all saw the email. Don't see that there's anything new in their syllabus, but I haven't heard any more detail on that. Did anybody, Tom? Have you got any thoughts on that?
It did look like it would be the kind of the same old. I think Bill may have proposed in the past that we look to kind of do that on an every other year basis, in which case this might be a good year to pass unless anybody feels the need to sit through that.
I'm amenable to that. I know a lot of it is aimed at people that just got elected in March.
Right.
Jack, you might need to go then.
I don't mind going, actually.
I think it's a virtual meeting, isn't it?
Yes.
Yes.
Oh, that's not good. You don't get any of that swag.
Oh, that's done in November. They may have another series of things in November anyway, which made a lot more sense to go to a variety of seminars than just the rehash that we're looking at this June. So I think we look forward to a November event. Any objections to that?
No.
Nope.
Okay. Any other final comments from anybody? Questions? Ed, anything from your side?
Did,
He's muted.
Oh,
did you skip CRF transfers?
no, you made a motion on it.
Oh, that was the motion. Okay.
I'm good, Chris, thank you.
Thanks, Ed. Appreciate you coming. Okay, then we'll have a motion to adjourn.
I move we
Motion to adjourn.
second.
All in favor?
Aye.
Aye.
Aye. 3-0.
Thank you, Cambridge Trust.
Thank you.
Adjourned at
Thank
10:02.
you, guys.
Thank you. Stay safe.
Merrimack TV is committed to our community. From gavel-to-gavel coverage of town and school board meetings, to updates on town services and projects, we aim to keep you connected.
Good morning, I'm Kyle Fox, Public Works Director for the town of Merrimack.
Hi, I'm Diane Trippett. I'm the town clerk tax collector for the town of Merrimack.
I'm Captain Matt Tarleton with the Merrimack, New Hampshire Police Department.
And keep the public informed of every motion.
All those in favor signify by saying aye. Aye.
And many moments, so you can be confident that we're here for you. Thanks for watching. Stay connected. Follow Merrimack TV on Facebook.